Here's what Warren Buffett has to say about avoiding the temptation to time the market.
A chance to talk to you. So what do you think's happened in the last 4 or 5 months since we talked to you?
Well, in a sense, probably not that much if you measure where we are now versus last September. But
we're weaker.
People
correction territory.
Yeah, I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I never felt that I knew it, and I never felt it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
You know, I know you look at things like that, but I also know that you look at stocks and try to decide if they're fairly valued, if they're overvalued, if they're looking cheap at this point. And we have been waiting for a correction for an awfully long time. That's finally come. Do stocks look cheaper to you, just based on where we've come?
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But stocks are going to go down. You could probably look it up as to what percent of the days, since I was born, they've gone down, and maybe it'd be 30% or something like that. And you can't predict what stocks will do, but in the short run. But you can predict that American business will do well over time. And just take the 20th century. Stocks went from 66, the Dow average, 66 to 11,497, and you were getting 3 times as much in dividends as the whole average was selling for at the start. And you had 2 world wars, and you had a Great Depression, flu epidemics, all kinds of things. American business will do fine over time, and if you own a piece of it, and if you don't beat yourself, the only person.
In the fast-paced world of investing, it can be tempting to try and time the market, hoping to capitalize on short-term fluctuations. However, successful investors understand the power of having a long-term outlook and resist the urge to engage in market timing. Instead, they focus on the fundamentals and embrace a patient approach that allows their investments to flourish over time. Investing with a long-term outlook requires consistency and discipline. Rather than making impulsive decisions based on short-term market movements, successful investors stick to a well-defined investment strategy. They understand that markets can be unpredictable in the short term but tend to trend upward over the long run. By adhering to their strategy and avoiding knee-jerk reactions, they position themselves for long-term growth. Emotional bias is a common pitfall in investing. When investors attempt to time the market, they often fall prey to fear and greed, making irrational decisions based on market fluctuations. Adopting a long-term outlook helps mitigate emotional bias by shifting the focus to the underlying value of the investment. This allows investors to make decisions based on a rational assessment of fundamentals rather than succumbing to emotional impulses. Compounding is a powerful force that can significantly impact investment returns over time. By staying invested for the long term, investors give their investments more time to compound and grow exponentially. Trying to time the market and frequently buying and selling can disrupt the compounding process and erode potential returns. Patiently allowing investments to compound over years or even decades can lead to significant wealth accumulation. Markets are inherently volatile, and attempting to time short-term fluctuations is an arduous task. Trying to predict market tops and bottoms consistently is virtually impossible. Successful investors understand that short-term volatility is a normal part of investing and are willing to endure temporary setbacks for long-term gains. By maintaining a steadfast approach, they ride out market downturns and benefit from the eventual recovery. Frequent trading and market timing often results in increased transaction costs. Buying and selling stocks frequently can lead to brokerage fees, taxes, and other expenses that eat into investment returns. By adopting a long-term perspective, investors reduce unnecessary transaction costs and keep more of their earnings for compounding and reinvestment. A long-term outlook allows investors to focus on strategic asset allocation. Instead of attempting to time individual stocks or sectors, they diversify their portfolio across different asset classes based on their risk tolerance and investment objectives. This approach reduces the impact of short-term market fluctuations on the overall portfolio and helps achieve a more balanced and resilient investment strategy. Time is a valuable asset in investing. Successful investors recognize that short-term market movements are often noise compared to the long-term growth potential of well-selected investments. They give their investments time to mature, allowing businesses and economies to grow and generate value. By embracing a patient approach, investors can capitalize on the power of time and reap the rewards of compounding and sustained growth. Having a long-term outlook in investing offers numerous advantages over trying to time the market in the short term. By maintaining consistency, overcoming emotional bias, capitalizing on compounding, and minimizing transaction costs, investors position themselves for sustained success. A long-term perspective allows investors to navigate market volatility, strategically allocate assets, and harness the power of time. By focusing on the fundamentals and embracing patience, investors can build a resilient and profitable investment portfolio that stands the test of time.